Thanks, Jeremy, and thanks, Michael. Glad to be here. What I thought I would do is start out giving you a little bit of my journey as to how I ended up in the real estate business. In the 1980s, I worked for large investment banking firms doing what were then called bootstrap, and then they became LBOs, and then eventually private equity. I formed a broker-dealer, ran a hedge fund for about 12 years. And as I began to invest my own private capital into other assets, I discovered the benefits of real estate for a whole bunch of reasons that I'll get into in a little bit. But what I found was that I didn't do particularly well picking individual properties. I gravitated towards real estate private equity funds for safety and size reasons and corporate governance. And I started to generate much higher returns, didn't have any bad sponsors that were providing these real estate deals to me. And what I realized is for any investors, accredited investors, investing relatively smaller amounts of money, whether it's 25,000, even up to about 500,000, it's difficult to access the best institutional real estate funds. And in fact, the institutional funds do outperform all other classes of real estate. So what I did just by pure luck is I started to invest with a group of investors, and we aggregated our capital into a feeder fund so that we could meet the high minimum investments of some institutional funds. And that gave us access to the better product. And then over time, as the amount started to grow into the multi-millions that we were investing in these funds, I realized we could get even better investment terms from the underlying fund. So that's my journey to getting to the point of starting my company, CityVest.com, which is a online investment marketplace allowing accredited investors to access institutional real estate funds. So what I thought I would do is start out this presentation with a review of why real estate, just so some of the numbers and the benefits of why real estate are known. Get into what what real estate private equity funds are all about and how to conduct due diligence on them. And at the end, I'll describe exactly what CityVest is doing. So I'll start by sharing my screen.
So we can see your screen. You just need to hit, yep.
From the beginning.
Yes.
Is that full screen, Jeremy?
Not yet. Hit it again, I think. I think you may need to hit, yeah.
Let me just check
it. You can
it.
share it if you'd like.
Yeah, let me just, there we go.
Okay.
Is that full screen?
Yeah, it is full screen now.
Excellent. So how to evaluate and invest in real estate funds. And those three topics that I'm going to be covering is why invest in real estate, why invest in real estate private equity funds, and then what does CityVest do? So why invest in real estate? We all know the attributes of real estate. I apologize to our two prior guests that I did not include Art or Wine on this list. But real estate has unique attributes that are quite different, obviously, from cash, stocks, and bonds, where it is a hard asset, provides a yield, it's leverageable, which is key to real estate. There are tax advantages to investing in real estate that are fairly significant, and over time, there's an equity buildup. So just going one by one, unlike stocks, bonds, and cash, real estate is a hard asset. It has an intrinsic value, whether it's multifamily, where everybody has to live somewhere, so it has that intrinsic value. And as we're seeing right now, it is a hedge against inflation, which is very important. I don't really get into it too much in this presentation, but the number one asset class that is correlated to inflation is real estate. Just the details, it does produce a relatively high cash yield. Cap rates today are around 5%, depending on the market. That would provide an unlevered return on real estate with leverage, and with growth in rents, obviously provides returns that are in the mid-teens, even 20% area. The leverage is important. Every lender in the world provides mortgage financing to real estate, easy to leverage and get your returns to a higher leverage level. It does provide tax advantages from depreciation that can be significant and provide a very high tax advantage to investing. And over time, it's been proven to build up a equity value. So just going through this relates to specifically to multifamily real estate, but over the last long period of time, 23 years, real estate has performed relative to stocks and bonds. Stocks in the last 2-3 years have performed extremely well, but as we know, stocks are relatively volatile, and over this long 20+ year period of time, stocks have had 26 down periods, bonds 21 down periods, multifamily real estate only 7 down periods in that long period of time. In terms of volatility and returns over the past 20 years, the best place to be is commercial real estate, where it has a relatively high return and relatively lower risk. The only thing that has a lower volatility on this chart is treasury bonds, obviously less volatility than stocks and commodities. We all know that the old 60-40 traditional portfolio was probably dead 20 years ago and has seen a long decline. Obviously, the people that were recommending art and wine would like to be included in this chart, but had you included multifamily in the last 21 years of a portfolio, your return in that combined portfolio of stocks, bonds, and real estate would have performed significantly better than if you just had a 60-40 portfolio of just stocks and bonds. Just a little bit about inflation over the past year, 2021. We've seen a rapid increase in inflation across the board, predominantly energy and food, but real estate prices have followed that trend, with multifamily rent growth being fairly significant, along with the inflation line, which is in red. Real estate rents have obviously increased at a faster pace than inflation has. In terms of rent and occupancy, this is over a 21-year period of time. There's been a steady increase in national rents as well as occupancy growth. That's owing to a couple of trends that are not likely to change in the next 30 years, and that is that the population in the U.S. is steadily growing. Back in the 1950s, we had only 160 million people in the U.S. We are now double that size over the past 67 years, and with a population of about 330 million today, it's anticipated by 2050, we're going to be at about 450 million people. So there will be a steady increase in rents and occupancy growth. So there has been a steady decline in home inventory. That's mostly because population is increasing, and so there's just not a great supply. And this again is over this 21-year period of time. We see the huge increase in in home price appreciation over the past year. And you can see that correlates directly with a lower supply of houses over the past year. If you follow Blackstone virtually every year in their annual report, they make this exact same statement, which is we invest in real estate with conviction through all market cycles and across the entire risk spectrum. So they continuously raise new real estate funds and are making investments. They wisely were investing back in the pandemic when there was slower investment activity. Blackstone was out with a new $20 billion fund back then. Obviously, that was well timed. They deployed it and have benefited from the increase in real estate prices over the past year. This is Yale's endowment, which is quite large, allocates a significant percentage of their endowment to real estate and to private equity. It's a well-known Yale endowment model where they advocate investing 20% of one's portfolio into real estate. It was run by a gentleman named David Swenson, who died about a year and a half ago. But most of the Ivies now emulate a real estate private equity portfolio. And if you compare Yale endowment portfolio to other colleges or inflation, you can see that over the past 10-year period of time, Yale's endowment has outperformed all others. Most of the people that worked at Yale's endowment now work at other endowments. So the move to private equity is occurring throughout the endowment industry. So why invest in real estate private equity funds? So just the analysis of real estate private equity is a fairly difficult process for any individual, whether you're looking at cap rates and understanding cap rates relative to inflation, what the equity multiple is that you can expect, exit cap rates, the manager qualifications, what sector of real estate you're in, core plus, value add, development. They're very different economics in each of those sectors of the real estate market. For real estate private equity funds, there's various fees, and the multiple on equity cap of invested capital varies by fund and fund type and manager. So when an individual looks at how they can get into the real estate world, a lot of people are finding that there are real estate crowdfunding platforms, and that's an easy way to invest in real estate. However, almost all of the deals on platforms are offered by real estate investment sponsors. Most of them are small, doing smaller transactions. So you can imagine that any transaction below $20 million, if it's a single asset, there's significant competition to buy that asset. We know that over the past year, that's particularly true. But even if you go back 5 years, anything that's a smallish asset obviously will have more people bidding for that asset. While if you get up to an asset that's 75 million in size, you generally only see real estate funds or family offices trying to buy those. There's not 20 people trying to buy the asset. And whether you're a family office or a fund, you're not going to offer a crazy low cap rate in buying that property or a very high price. You're going to do it based on your pro forma modeling. So I tend to find that real estate crowdfunders who are dealing with smaller sponsors and single deals, typically there's lots of fees, and the assets are not the assets that the real estate funds would invest in. That's how they ended up on a real estate crowdfunding platform. In terms of sponsors that are out there, there's thousands of sponsors all trying to syndicate their equity for a given transaction. And there's not great pro formas and insight into the deals. And you have to have a significant amount of trust in that sponsor in order to invest in that individual property. REITs, we know, have relatively low dividends, 3, 4, some have 5%, but being a REIT, generally having public expenses, brings down the possible distributions that REITs can make to their shareholders, and they just don't match up with what real estate private equity funds. So the hurdle with real estate private equity fund, while they are the best way to invest in real estate, the best managers that all of a sudden have 50 million or 100 million or even 500 million in AUM, the better managers typically have very high minimums, so they're difficult to access real estate private equity funds. Specifically regarding a comparison between private equity funds and REITs, this was a study done by someone well-known in the real estate industry named Peter Lehman. He is at the University of Pennsylvania, and he did a study of returns of real estate private equity funds versus REITs and found that private equity funds far outperformed REITs, mostly because of REITs' expenses for being a public company. And specifically, this chart highlights those fees, but whether it's the asset management fee or the management expense reimbursement in a REIT, dramatically brings down the possible net return of a REIT down to, this is on a hypothetical $10 price, would bring down a non-traded REIT return to investors down to about 3.3%, while in a private equity fund, expenses are quite a bit lower and could return an 8% return after expenses. So some of the attributes of real estate private equity funds, because it is a larger fund, and they purchase, whether it's 5 assets or 20 assets, it becomes a highly diversified asset. Everybody knows that the way to invest in anything is to have a diversified portfolio. You get that from any one real estate private equity fund. These funds also have professional investment management teams that have been together for years. The team may include a capital markets person, the acquisitions person, the value add or development people, the staff for accounting and reporting numbers, the staff to do a cost segregation to maximize the amount of depreciation early on, and then the person who might be involved in dispositions of the assets to maximize the selling prices. As I've said, with a fund, there's a pass-through of the tax benefits because all real estate private equity funds either use an LP structure or an LLC, where all of that depreciation passes through to the investors. In a fund, there's generally a focus on long-term capital gains, while everyone can appreciate getting cash on cash or current distributions. Typically, because of the equity buildup in real estate and some of the value add and development strategies, there is a big payoff when an asset is sold and stabilized, and that will produce a long-term capital gain. Maybe one of the downsides to real estate private equity funds is that they are illiquid for a period of time. Some funds are 5 years, 7 years. Many of them have extensions for a couple of years, just in case a asset or 2 or 3 haven't sold within that 5 or 7 year period. What I find is most investors that initially are concerned about the illiquidity, people like the Yale Endowment found that illiquidity actually can have a benefit where the focus is on the long-term gains. And while there is a illiquid period of time, that's the time period that you can build up the equity value, stabilize the property so that over that 5 to 7 year period, you can generate that long-term gain. And then finally, what I think is frankly one of the most important reasons to invest in a real estate private equity fund is the fact that if they are a somewhat seasoned manager, they will always have a prior audited track record. It's verifiable to see how they performed in the past. You can dig in and look at any individual assets, but it's also important to see a diversified portfolio and how did they return what was the return on that diversified portfolio. And when I say that it's a audited realized return, that would obviously indicate that they have auditors on staff as well as a administrator, which provides professional investment fund governance so that you can trust the numbers. So just to highlight why real estate private equity funds tend to outperform, real estate private equity funds tend to have more sophisticated value add, opportunistic, and development investment strategies. REITs and single assets tend not to be as sophisticated. REITs definitely stay away from any sort of development or value add work, as well as opportunistic. But that is the most attractive section of the real estate investment world, where you can have truly unique managers that understand a market, can develop properties, stabilize them, and then sell them at a high price. In terms of deal sourcing, if you're a real estate private equity fund with $50 million in the bank, your ability to source deals is far superior than a sponsor that doesn't have cash in the bank. So if you go out to buy an asset, technically with a investment fund, cash in the bank, you could pay all cash. Your ability to get financing is that much greater. Your terms will be greater. And if there's a seller in a market, a seller doesn't want to sell to a sponsor without equity. Those guys are just fishing around, while someone with an investment fund is serious. They have the capital. They don't need to crowdfund the equity on each acquisition. They have the capital in the bank. So deal sourcing is much more opportunistic for a fund where they have the capital. That covers the cash in hand. And then in terms of expertise, the only way that a private equity fund gets to manage 50 million, 100 million, or 500 million is that they've performed, they have experience, they have a great strategy, they know their market, and that's why institutional investors have given them the money to manage to achieve those rates of return. So who can invest in real estate private equity funds? So it typically has been a market of very large funds for qualified purchasers. That's 5 million on up in a portfolio. There are some funds that allow accredited investors, which is $1 million net worth and some other income tests. So it's somewhat difficult for a accredited investor, if they have just $1 to say $5 million, for them to invest as much as what's needed in a private equity fund, which could be up to $1 million. So typically an accredited investor has a difficult time. Absolutely, they're not going to get into the large Blackstone funds, which have $20 million minimums. But even some of the $100 million size funds, an accredited investor may not have the $500,000 or $1 million minimum investment size to get into those funds. So the key criteria for us for investing in a real estate fund is a prior audited track record, as I've said. But there's a lot more to consider in these funds. So there are right now today, actually this goes back to January 2021, over 1,000 real estate funds in the market. For any individual wanting to assess what they should invest in, they just have no capability of reviewing. Even 10% of that market would be 100 real estate funds. It's a daunting task, and each fund has different markets in the US, different strategies, whether it's core, core plus, opportunistic, distressed, and then it may be in different sections of real estate, ranging from industrial, medical, office, retail, hospitality, multifamily, all have different dynamics. So there's just way too much for a individual to assess. Even for family offices, they can't possibly have the expertise in all of those markets. For the strong real estate private equity funds, they have a range of capabilities that helps them get through this process. So they have specialists handling the acquisition side, the accounting side, capital markets, and disposition. And they have the people who are specialists, whether it's in development, value add, or distressed. So in terms of real estate fund due diligence, what you need to look at is the level of expertise of a real estate private equity fund manager. We tend to look at only funds that have 50 million of combined principal experience. Obviously, it's better to be at 100, 200, 500 million, but the minimum size is 50 million of principal experience and at least 15 years of principal experience managing real estate acquisitions. In every fund that we look at, we make sure that there's strong corporate governance, including an auditor and administrator. We want the investment manager to have a key man life insurance policy, just in case something happened to them. We want that manager to have skin in the game, to have a investment in their own fund that's significant, gives us comfort that they're not just managing the fund for the investment fees. We also do background checks in FINRA and SEC databases, social media, and other places. And then we employ services to do some background checks for lawsuit judgment liens to make sure that there's nothing in the background of that manager that might cause a problem in the future. Then the next thing that's important if you're looking at investing in a real estate private equity fund is the ability to understand the limited partnership or LLC documents and the terms. They tend to be anywhere from 60 to 120 pages. There's generally two different agreements that you need to dig through. One is the PPM, but the more important one is the LLP or the operating agreement of the LLC. And there's a range of terms that you need to be very familiar with, ranging from calculation of the preferred returns, the waterfall, understanding 80-20, 75-20, the catch-up provisions, the catch-up on the pref, catch-up on the rebalancing contribution, which would bring a investor later in a later stage in a private equity fund to bring them back to the closing early on in that year-long capital raising period. You need to understand their filing of federal taxes and state taxes, what the term of the fund is and extensions, and lastly, the targeted IRR. So just to recap, real estate generates strong returns. We covered that early on, low volatility. Real estate outperforms REITs and other sponsored deals. Institutional real estate funds are typically the best category, produce the highest returns. The real estate private equity funds have the best due diligence because of the use of corporate governance, auditors, administrators, and you have to pay special attention to the investment fund documentation. So just to cover, to wrap up who CityVest is and what we do. So CityVest is a online investment marketplace where we provide generally accredited investors and some qualified purchasers with a unique access to institutional real estate private equity funds. And the special attribute is not just the access, but we do that with enhanced investment terms. And I'll explain that in just a minute. So generally, we are at this online platform. There are low minimum investment sizes through the CityVest platform. I think that we do a superb job in finding attractive investment niches within the real estate market, funds with high preferred returns, proven track records. They're institutional funds, and they have unique investment structures, whether it's in distressed senior living. Our favorite category has been multifamily, but there are other attractive industrial properties, mobile homes, and storage. So what CityVest has done is we've created a new way for accredited investors to invest in real estate through our feeder funds or access funds, where the underlying funds are typically targeting anywhere from a 15% net IRR to 25% net IRR, although that's come down a little bit recently. We handle the investment monitoring. These funds all have a diversified portfolio, and they're all institutional quality investments. So here's specifically what CityVest does. It's a long process. We review about 700 funds per year. We're only looking at those funds that meet a minimum size requirement. Typically, those funds that are raising 40 million or more, they all have to have auditors, administrators, have to have strong historical audited realized IRRs. Right now, we're only looking at funds that have a 20% net IRR on those in that track record. We hire a third-party due diligence firm named Buttonwood to handle some of the due diligence and background checks. And then we set up a single purpose vehicle, a feeder fund, which we call an access fund. And it's through that access fund that we pool capital so that it becomes a sizable investment amount, typically 4 to 6 million in that feeder fund vehicle. With that amount of capital, that allows us to gain access to the institutional funds. And because we are a sizable investment at that point, we can then negotiate and structure better investment terms into that underlying institutional fund. But we do that allowing our investors to invest as little as 25,000 into our access fund, although we certainly have lots of investors at 250,000 and 500,000 because we are providing these enhanced investment returns over and above what a family office or a large investor could get on their own. We make these investments available through the CityVest website so that you can review everything about our access fund and the underlying fund through the website. There's 7 tabs so that you can read the summary, look at the strategy of the fund, review the team, the track record, investment terms, and all of the documents that you could want from both the underlying fund and from our access fund. To make an investment, you click on a button that says Invest Now, opens up DocuSign. You fill in information in DocuSign, provide some documents. All of that ends up to be listed in a dashboard so that you can see what you've invested in, what distributions you've received, and that's also where you would get the annual K1 for your investment. So we like to say that CityVest is a better and smarter way to invest in real estate. So early on, it was mentioned that we have a star value proposition. The safety element is that we have methodical screening of hundreds of real estate funds and a third-party due diligence report. The trust factor is the use of by all of our funds of auditors and administrators so that you can trust the numbers. Access that relates to providing access to institutional funds that sometimes have high minimums, certainly much higher minimums than a smaller accredited investor, which might want to only invest 25,000 to 100,000. And then lastly, returns, because we have this pooled vehicle with 3 to 6 million, we are able to negotiate a higher return. Typically, it's a 12% preferred return, followed by 80% of profits. Some of our funds, underlying funds, are offering direct investments at an 8 pref, followed by a 75-25 split. And we typically are at a 12 pref, followed by 80-20, although we have achieved a 14 and 15 pref in the past. So here's an array of the deals we've done in the past. One name that you may recognize is Apex. That was the name of our access fund, Apex Access Fund. That was investment into Apex One, a fund that we've done extremely well with. They've been on FLIA for many years, and we've performed well with them. All of our funds typically provide underlying returns over 20% net IRR. So in terms of marketplaces, to get to the subject of the conference, which is investment marketplaces, we like our positioning in the top right quadrant, which is the fact that we provide institutional private equity funds, institutional structures, that's the top side, as compared to individual sponsored deals that we don't think very much about. And on the right side, we make them accessible to individuals, while the left side is more institutional investment sizes, 250, 500,000, or $1 million on up. So some of the comparables, iCapital, Mercury, and Case, are not strictly real estate. In fact, none of them have very many real estate funds at all, but they are typically for qualified clients or even qualified purchasers. So that wraps up. This is just an overview that CityVest team members have well over 100 years of investment management expertise. We have this unique investment structure through our access funds, providing us the ability to invest in underlying real estate private equity funds, and all of our funds are institutional funds.
So you have a couple questions.
Excellent.
All right, so one is, what is the size of CityVest in terms of AUM, and what does the due diligence firm exactly do?
Yeah, so we've done 15 access funds. AUM right now is 55 million. So we're relatively small, although I think that we have recently been discovered by a large number of underlying funds that want to come to CityVest to raise that incremental $5 million. So just to put it succinctly, we're something like a online fund of funds, and many underlying funds are now seeking us out to invest in their funds. I'm sorry, what was the second part of that question?
Yes, second part of the question was, what does the due diligence firm exactly do?
Yes, Buttonwood. So they go into LexisNexis and their databases to do background checks on the investment managers. Obviously, that includes whether there's liens, bankruptcies, lawsuits, all of those potential issues. They read through the auditor and administrator's agreements. If it's a smaller service provider, they will actually interview that manager and see what their procedures are. The administrators have all been fairly large entities right now. Our fund is using SS&C, public company, multi-billion-dollar market cap. They do a superb job. They verify the amount of deals and years of experience of underlying managers. They read through the key man life insurance policy to make sure that if something happens to that manager, that the fund management will have some continuity. They also go into SEC and FINRA databases to see if there's any issues that have happened on a securities level.
All right, cool. Are you still looking for investors for CityVest? We know the answer, but can you hear me?
So, yeah, so
Okay.
So CityVest launches a new access fund about every month. Our current fund has a very unique structure in that it is a GP co-invest structure. So there are limited partners, typically family offices, in each of the deals that the fund does. And there's a promote or a percentage of profits paid by those underlying LPs that's paid up to the GP. That's where we sit. So we are sharing in that promote. It typically adds a 4 to 10% bump in the rate of return. As a consequence, our current fund that we're investing in, named Catalyst Real Estate Fund, is targeting a 20 to 25% net IRR. Underlying LPs in each deal, obviously, are getting something around a 16 to 18% net IRR, but we have that enhanced return from the sharing in the promote of that LP investor.
Okay. What are some of the common objections you hear from fund managers who are unsure about using feeder funds, and how do you respond to those concerns?
So fund managers don't really have any problem with our investing because we are just one more investor. In fact, many managers get approached with the following question: can we invest $100,000 in your fund? And if it's a $100 million fund, they just don't want to deal with those investors at $100,000. They may have a minimum investment size that's $500,000 or $1 million. So we are happy for that fund manager, the private equity fund manager, to give us the names of those smaller investors. We aggregate all of those investors into our fund, and the underlying fund doesn't have to speak to hundreds of small investors. We manage all of them. We do our accounting for our feeder fund. They give us one K1, one quarterly distribution, one quarterly report, and we manage all of our investors through our investment management portal. We distribute all of that information. So to a large extent, we make the underlying fund manager's life easy by aggregating a lot of the smaller investors that might approach them directly. We aggregate them in our fund, and we make that larger investment into their fund. Our $3 to $6 million amount is usually much larger than the average 1, 2, or 3 million that's invested directly into their fund.
Awesome. How do you market CityVest services to RIAs, aggregators, and family offices?
Yeah, we don't really work with too many RIAs or financial advisors. This is the only way to be able to get returns up to 20% is to, at all levels, to squeeze the fees down to very low levels. You just can't do what a REIT does and have multiple layers of fees and huge marketing fees. So we do charge a fee at the CityVest level. We think that fee is justified because we've typically obtained a 12% preferred return from the underlying fund manager. They're happy to pay us the higher pref because we're taking a lot of their marketing effort off the table. It's somewhat our fee for doing that effort and the administrative job to consolidate all of those investors into our feeder fund. But so we don't typically work with RAs or wealth managers, except if they are fee-only managers. Otherwise, we market directly to individual accredited investors, and we have right now about 700-800 individual investors that have been coming into deal after deal. We have some investors that have done 10, 11, and even 12 different investments in our access funds.
Okay. What is the tax rate on your existing fund?
So these are all pass-through vehicles. So there's no tax rate on the underlying fund manager, and there's no tax rate on our feeder fund vehicle, which is an LLC. All of the income flows through to investors, including the accelerated depreciation that comes as a result of cost segregation. All of that flows through to investors. In many of our funds, there's no tax to be paid on the income earned in the first year because of these significant tax benefits. I would also point out, we understand private equity funds extremely well. So if we are an investor late in a calendar year, there are a couple of significant benefits that most investors don't even think of. For example, we've invested in a couple of funds on the last day of the year, December 31st. What ends up happening is we get a K1 3 months later in March, and we've gotten a full slug of the prior year's depreciation because the auditors are calculating depreciation for any investor in the prior year. Well, we were an investor for literally one day of the prior year, but we're getting a full slug of the depreciation allocated to us because we are on the, we are receiving our pro rata amount of depreciation because of that one day investment. So that's one benefit. Another benefit is that typically in a private equity fund, they have something either called a rebalancing contribution or a catch-up interest rate to bring your investment that might come late in the capital raising period, brings it back to the first closing. Typically, it's about an 8% interest rate that you might have to pay. Our access fund typically negotiates that away so that we don't pay that 8%. In one case, it was the very tail end of an 18-month capital raise period. We would have had to have paid not just 8%, but about a 12% catch-up to bring us to the first closing. We got the manager to waive that charge. And so because it was at the end of the capital raise period, they had a full portfolio. It was not a blind pool. They had made 50 investments in this. It was another GP co-invest fund. They had made all of the investments. We received our first distribution literally 2 weeks later without paying the catch-up, the catch-up interest, and we received a full slug of depreciation. So it's that kind of analysis that we understand real estate private equity funds as well as anybody in the market, and we can pick up unique opportunities like that.
All right. One person asks, what fees does CityVest charge at the access fund level? You may have already covered, but can you cover it again?
Yeah, so we charge 1.75% per year in a administrative fee. We do not charge a percentage of profits. Some of our funds do not even charge a management fee. So our current fund, Catalyst, is a GP co-invest fund. They do not charge any management fee. There's no property management fee. They're only charging a percentage of profits at their underlying fund level. So for us to earn our 1.75%, while that does go against the ultimate return that we get from the fund, in this particular fund for Catalyst, we've negotiated a 12% preferred return, 4% higher than underlying investors get. Plus, we've negotiated 80% of profits rather than 75% of profits. We think that it's a value proposition for the investors to pay that 1.75% annual fee.
Okay. How much do you and other principals typically invest in each access fund?
Sure. We've done 15 of these funds. We typically invest just $100,000 in each of our own access funds. So it has added up to well over $1 million that we've invested in our own funds. We are raising some additional capital for CityVest. And so CityVest will be investing more capital into our access funds. In addition, we'll be raising a CityVest Opportunity Fund, which will be used to provide liquidity to any of our individual investors that, while it might be a 5 to 7 year fund, if they want to get out in year 3, 4, or 5 from CityVest's own capital, we would provide liquidity to that member of that access fund so that they can exit the fund if they want.
All right, that looks like that's all the questions. Is there anything else you want to cover? And why don't you tell people where you're located?
Yeah, well, we're located in Manhattan. I've stayed here straight on through the pandemic. The website is cityvest.com. There's a button that'll say investments. You'll see the array of transactions. We're closing our Catalyst investment in just a week on May 16th. So if you're interested in looking at that deal specifically, you can go to investments. You'll see the Catalyst investment. We do have additional funds that are following up in June, July, and August. So take a look under investments. You'll see the links to the summary, strategy, track record, team, terms and documents on our webpage. If you want to email me, if you want to email me, I'm at alan@cityvest.com. And my phone number is 917-747-3091.
Awesome. Well, was there anything else you want to cover, or we can conclude your broadcast?
Yeah, I'm good. Thanks everyone for joining. Appreciate the opportunity to describe our unique platform and access to real estate private equity funds.
Well, thank you so much. And thanks everyone for joining our platforms event. Stay tuned as we'll have many more. Oh, it looks like one last question. Oh, someone thanked you and said you did a great job.
Thank you, everyone.